My name is Jeff Walton, Chief Risk Officer of Strive. I think I might be the only Chief Risk Officer in the industry. So happy to be here, happy to talk about risk. Yeah, there's some others apparently. I just came from Prague. I spent 2 days in Prague before this, and now here in Amsterdam. And I've now heard several stories about how different cultures and societies interact with different monies and view their world through the lens of finance. So we've got 3 exceptional people here on our panel, all with completely different backgrounds. So I'm going to let each one of these guys give an introduction of themselves and then just talk a little bit about how you are seeing risk in your industry or your area of work and what your current challenges are with risk.
Thanks. Thanks to all of you for the invitation. Also, a pleasure to be on a panel with you. I've been following your work individually, but also what Strive is doing is just awesome. And anyone who hasn't caught it yet, catch the most recent hurdle rate pod with Tim, who's back here. That was just gold, man. For anyone building a treasury company in an earlier stage, so much great stuff shared there. My name is Boyd Cohen. I'm obviously American. You can probably tell from my accent. Have lived in lots of places, most recently Europe and Spain for 9 years. I moved to Mexico a year and a half ago. I got very deep into Bitcoin over the past several years, wrote a book earlier this year. The first book, I believe, published with a chapter on Bitcoin treasury companies. And several months ago, I joined a company that was originally called Capital X that is the longest running Bitcoin services company in Mexico. You could think of it as like the river from Mexico, if you will. We have a range of services, Bitcoin-backed lending. We have a pretty active trading business around Bitcoin for our customers. We have a credit card, which will soon have Bitcoin cash back. Kind of like Byte Federal, we're kind of doing this combination of being an original Bitcoin services company that has native Bitcoin in organic ways we generate from our core businesses. And we're now accelerating the treasury strategy with our first instruments, hopefully being available in the public markets within the next quarter or two. The risk we see in Mexico, I think, is the tolerance for risk and the view about risk in Mexico with respect to Bitcoin and treasury companies, I think is quite unique, at least compared to what we see out of the US markets in particular, probably Europe as well. The Mexican investor, the pension funds, et cetera, they tend to be more conservative. They're less forward. They're less knowledgeable about financial engineering. Things like an instrument that has a yield that is the only pathway to service that yield payment is raising future capital. That to the Mexican institutional investors seems like from another planet. Like they don't see that. So, we're building instruments. In fact, Matt Cole has advised us. I'm not sure if I should say that publicly, but I just did. We have gotten some advice from him, which is amazing. The quality of people in this space that are so generous to help the younger treasury company is pretty awesome. But the short story, so for example, one of our big targets, and it's kind of a bridge to the last panel, I think. One of our big markets we're going after are the pension funds in Mexico. There's $350 billion in pension funds. They're called Afores. They're capped at having 20% exposure to foreign securities, 30% cap on like true equities, and the rest has to be some kind of fixed income. So, and that's because of their risk tolerance. They don't want pension funds with a lot of volatility, et cetera. And so there's a huge market for us there. So we're actually going to tap into this sort of risk aversion of the Mexican institutional investors, provide them instruments that are less risk averse, that seem less volatile, where we basically monetize that volatility and try to meet them where they are. So that's kind of our view on risk, that the general investor, the high net worth, the institutions in Mexico, more risk avoidance than you see in other markets. But there is a pathway to sort of capitalize on that. That's what we're working on.
Great. Sadiq?
So I'm Sadiq Jaffer. I work for KPMG. From a risk point of view, just being able to say at a Bitcoin conference that you work for KPMG is quite an achievement. It's been a 2-year journey for KPMG to get to this point, for me to get to this point where I can actually come to conferences and talk about Bitcoin. KPMG as a company is very, very risk averse, as you can imagine. So just getting through the approvals to actually talk about Bitcoin, to publish about Bitcoin, to come and talk at Bitcoin events and wear a name badge that says KPMG has been one hell of a journey. And now I've got the small part of trying to talk to our clients about the risk that I have to deal with as well. So we've overcome one hurdle around risk, but now we've got the big challenge to come. So yeah, that's the risk point for me.
You should ask, or you should apologize instead of asking for permission. So no, I comment on that. Sorry, I need to make that comment. I worked at PwC before, but it felt a little bit better. But anyway, no, sorry. I'm Stefan Lutz. I'm German, but I live in Singapore. I'm the CEO of BitMEX. BitMEX is the oldest still running crypto derivatives exchange in the space. We were founded like 13 years ago. We were operating for more than 11 years. And actually, it is something like in between. So number one, so derivatives was at the core of what our founders wanted to build, because it allows you to trade Bitcoin in particular at that time, way more capital efficient than trading spot, number one. They solved counterparty credit risks in derivatives trading, big thing. I come from TradFi originally. And it was accumulating Bitcoin. So you could say it was basically one of the first digital assets treasuries, but not so much for the public to distribute, but for the founders themselves. So they wanted to accumulate Bitcoin because everything runs on Bitcoin in our company. We collect even fees in Bitcoin, not in US dollar. We are more or less, not like a DEX, but on chain. So that differentiates. But at the same time, we're very much corporate, because what we do is like the perpetual swaps that were invented by our founders that are used throughout the whole industry right now. And the settlement mechanism, everything is very, very corporate, very, very TradFi actually. And it always followed the, let's say, not slogan, but the motto, like, don't lose the fucking Bitcoin, which still is a thing. We are the only company that provenly has never lost a Bitcoin of our customers. But it's more like zero risk. What does it mean? It means zero non-wanted risk. Because, my original background is TradFi. I started in a bank. I was at a trading desk. I worked in audit. I worked actually at Deutsche Börse with Eurex as the brand, right? So like CME. For a long time, I've been 10 years PwC partner. I headed the capital markets department, and then I joined BitMEX late 2020, early 2021. But what was before, and I want to speak about that, and it was so amazing being here. Why? I'm, let's say, a Bitcoiner, but I have a twist to it. For me, it's not just Bitcoin. Bitcoin is the money part of it. Bitcoin is the reserve asset part of the digital economy. It's actually globalization, how it should be from my point of view. But my awakening moment was when I advised, at PwC, some of the central banks in Southeast Asia. And I advised them on financial stability matters, because that was at the core of what I did at that time, and on, you would call it probably financial inclusion. And I learned how many, coming from Western Europe, totally ignorant, I learned how many people do not have bank accounts. But at that time already, it was like 2016, 2017, they already had like what I have here, like mobile devices. And they were in some way, shape or form connected to global economic flows, producing palm oil, producing clothes, etc. And that got me actually into the, I always say blockchain economy, because I'm totally thrilled about DAOs still, distributed autonomous organizations. It's the digital equivalent to European cooperatives that can work cross-border. And then that leads to Bitcoin, because how do you settle bills cross-border? Well, you should use Bitcoin. It's the hardest currency out there. But coming back to risk, right? Sorry for that, but I wanted to share that. Coming back to risk, I hate the word, because risk says nothing. Mathematically, risk just means deviation from expected value. That's all. It's neither negative nor positive. It just means something ended differently than you thought. That's it. So while working on getting this, it's like this mu sigma distribution for the quants here, right? So you have an expected value and the standard distribution around that. What risk managers do is they want to narrow that down and say, no, we land exactly at the expected value. It's like you do budgeting in a corporate and you need to hit your budget. It's totally stupid. You take financial risks, you want to be at the expected value. Actually, what you need to manage when you manage risks is you need to know the curve and then know how to play. Then it's good. Second thing is you need to adjust your expected value. If your expected value is set on the wrong path, you don't go anywhere. And I studied that shit, sorry. I mean, and this is why I don't like, because risk goes, oh, stay away from risk. No, if you know what risk you take, that's business. Business is taking risks. No risk, no return, because you solve problems for others that can always go wrong. And I would invite anyone who's in the corporate world who wants to incorporate Bitcoin or other digital assets. I mean, Bitcoin is the best one, but other digital assets into what they do. This is what you need to keep in mind. It's not like, oh, there's a risk. No, don't speak like this. It's like, what's the risk? How do I manage it? Can I make money with it? If the answer is yes, take the risk, full stop.
What's the risk appetite?
Yes.
Yeah, I think that's great background, right? So, I mean, whether people believe it or not, everybody in this room has actually underwritten the risk of Bitcoin, right? If you hold Bitcoin, you're inherently doing it by understanding the asset, understanding the volatility.
We've underwritten the opportunity of Bitcoin.
The opportunity, right? But I mean, they're risk takers, right? So, I think one thing, completely agree with you. All of this is very mathematical, and I think the development and advancement of disseminating the mathematical information is like how this entire industry advances, because I think it's fundamentally lacking a lot of the mathematics behind it, and I look forward to that future. But Sadiq, I'm a bit curious to get your perspective. Like, what are you hearing from your clients? Like, how are they viewing risk? Maybe they've never seen Bitcoin before. What are the challenges and what are the questions that we need to solve in order to help them out?
So the clients that I talk to, the spectrum is really wide, because it was only a month or so ago I was having a conversation with clients actually explaining what Bitcoin is, and I had to explain what stablecoins are, and I had to explain what other cryptocurrencies are. So some clients are that immature with their understanding of this industry. At the other end, you've got clients that are asking very detailed questions around, okay, how should I diversify my balance sheet into these different types of assets? What type of analysis should we do? Should we treat this like we're analyzing an equity? Where does the cash flow of this come from? Where does the yield come from? And then you get into these very detailed conversations, but it's an educational thing. Some people still don't get it. And I think to some extent we are guilty of overestimating how much sometimes people understand about this asset and this asset class. And sometimes we really do have to dial it right back just to take people on that journey.
Yeah, and we're seeing a fascinating evolution here, right? So typically you'd have Bitcoin as an asset, which is incredibly volatile, right? We were talking about large standard deviations of returns and volatility, and typical corporations, especially young corporations, may not be willing to take on that volatility risk. So you got to be able to communicate and emphasize different ways to view volatility. But now we're also seeing the creation of these new instruments that have different risk return metrics, right? The entire strategy suite of products, our new product, and future digital credit products that are out in the market. And that's now creating this efficient frontier of products where these companies and people can now get an efficient portfolio and have Bitcoin exposure with different metrics. So, Boyd, I'm curious to get your perspective on, like, how do you tap into that credit market in Mexico? How do you get there? What's the next step?
The beauty of the sort of low risk tolerance in Mexico is that there's high appetite for fixed income, as we discussed. And there's also a unique advantage we have in Mexico, which is a private company, which is what we are now on the journey to being a public company. We have a path to listing public instruments as a private company on our journey to being a fully public company. The challenge we have is the first instruments by law can only be available to accredited investors and institutional investors like pension funds. And of course, those are very risk averse clients. So we have to design instruments, and we're being very inspired by the preferred instruments that are being released by Strive and Strategy and others to design one that actually works for our market. And in that case, and this goes to this risk topic quite a bit, is that we're having to design in basically plan A, B, C, and D to be able to meet the yield requirements of these fixed income instruments. So sure, like all treasury companies, our preference is to leverage future raises to actually meet the requirements of these yield payments. But we have plan B. We actually have an operating company in the Bitcoin space that generates Bitcoin in revenue and is profitable, and we're working on scaling that underlying business, and that can also provide retained earnings that either flow into our treasury and or service the yield payments. But eventually, as you go down the stack, I know this is very controversial in some Bitcoin treasury communities, but I'm going to say it out loud here for the first time because we're not on video. We have to create an option whereby we have our own Bitcoin-backed lending program that we offer to our customers already. We can tap into our own Bitcoin-backed lending program to move some of our Bitcoin in treasury into our own lending product and take out fiat to actually service the requirements of the yield payment. So this is basically a way that we have to do, especially in our early stage of our journey, because unlike a lot of treasury companies where their early Bitcoin stacking comes from retail investors, we can't go to retail because we're not legally allowed to in our stage of public listing. So we have to raise through more conservative channels that require that we design instruments in this way. We think in the future, our instruments will look a lot more like the ones you guys just released, but the early ones have to be triple, quadruple backed to service the risk tolerance of those pension funds, et cetera.
Right. There's a lot of financial engineering going on and a lot of design elements taking into consideration. So we're coming close to time here. And, one thing that I would like to share, I think, the really unique element of some of these Bitcoin treasury companies is they're effectively pooling the risk of Bitcoin to offer the reduced volatility products. And that's kind of the advancement of this ecosystem and the Bitcoin market is, it's really difficult for a lot of people to hold a 50 vol asset. Like it's not for everybody and not everybody can hold it. For example, insurance companies, they can't even put Bitcoin on their balance sheet because they have zero ability to lend against it. So there's no incentive to hold it. But you can hold equity. You can hold equity on your balance sheet. You can hold preferred stocks on your balance sheet. And the regulatory authorities give you a risk-based capital credit for holding those different instruments. So these are really the Trojan horse into some of the largest capital pools on the planet. So with that, I'll kick it over to you. Stefan, final thoughts.
Final thoughts. I want you. I mean, with the title of the thing, I want you to remember a couple of things. That's just on my. If you are engaged in the corporate Bitcoin world, you need to be super clear about who do you serve, because what you provide is, and don't mean in a negative way, you provide just a wrapper. You make Bitcoin exposure available to someone who doesn't want to hold Bitcoin directly, because you could hold it directly, number one. And all the financial engineering around it is just like distributing and slicing and dicing that. That's all. Everything else that comes on top is something that's additional risk that has nothing to do with Bitcoin, frankly. Number two, if you want to reduce volatility, you can do so in the Bitcoin native ways. Go to the original crypto exchanges who offer derivatives like BitMEX. You don't need to come to us, but there are others. Why? You can do basis trading, no volatility. You basically lock in your price and you have a natural yield from funding. Easy stuff. So there are all those instruments you just need to know. And the better you know, the better you can provide for your customers that you provide the wrapper for, right? So this is what I want you to remember. There is no, for me, like big volatility in this. If you know how to manage, you can do it. What we see is that more and more companies come and they don't know how to do it. They increase the volatility. They do financial engineering on top of it without So you know what you do, you know exactly your customers, and you design it for them who don't know what they do and who they actually want to tap into. If you know, you can manage all the risks that are out there. We have the tools ready for this. And if you're personal, if you're private, think about whether you want to own Bitcoin directly or via digital assets treasury. And you need to know why as well. I hold my Bitcoin directly. Sorry for that, but this is just me.
So from my point of view, the volatility is just something my clients just don't want to deal with. Most of them are just actually looking for managed services. They just want someone who's going to deal with this for them, that's going to provide a product for them which is fairly stable, doesn't vary very massively, provides a decent yield. That's why they're quite keen to just work with people that can provide this type of product, the type of products you'll provide, the type of products you guys are talking about. These are perfect for clients of a company like KPMG that are highly conservative. They don't want to deal with custody. They don't want to deal with volatility. They want simple, easy to consume products, things that can be easily accounted for, things that can be easily integrated into their balance sheet using methods that they already know. If companies can provide that, then the adoption curve is just going to skyrocket.
Boyd?
The last thing I'd like to say, so for example, in Mexico, I keep talking about the pension funds because that's a sector we're really going after. There's 70 million Mexicans who have pensions through this Afore program. The Afores are generating around 8% annual return, and the M2 growth in Mexico is 10%. So basically, these pensioners are actually losing money every year, leaving their money in these pension funds. So we believe we can create a risk mitigated strategy to address what he just said as well, which is how can you provide a constant yield, which is what these pension funds need by law. 50% of their deployed assets have to be in fixed income. We can provide, as you guys have all proven ahead of us, that there's a way to provide a very steady yield that's way above what the current returns are in these pension funds. And we believe, and this is like a subversive thing, I think all of us are doing, and it goes back to the last panel about like how can treasury companies really change the world? I mean, if you can actually allow these higher yield instruments backed by Bitcoin to actually insert themselves into the pension funds of 70 million people, we're going to orange pill 70 million people in Mexico gradually because they're going to start seeing the pension funds that buy our issuances are going to start having superior returns, and the other pension funds are going to have to react to that, and they're going to start realizing why the returns are better is because Bitcoin is powering these pension funds, and then we'll start to see an accelerated path to adoption from mainstream. And I think that's something that all of us really in the treasury space are achieving in different ways by making Bitcoin powered products that are superior to what's on the market, getting them in the hands of more and more people. And I think this is misunderstood or misappreciated by the broader community. It's something we should reinforce more. There's a lot of trap capital. There's a lot of people that can't buy Bitcoin spot and hold it for a lot of reasons. And these can be a great way of getting access to either the vol if you want it or the better returns in the yield if you want it.
Excellent. Thanks for sharing your brain power and appreciate the time. I think it's time for a beer. Yeah?
Thank you.